Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, July 2nd, 2025. Just a reminder, we're going to have the markets closing early tomorrow for an abbreviated session, and then the 4th of July holiday, Independence Day, markets will be closed, so we have that really abbreviated trading week. As I mentioned recently, this week it's pretty what I call peak, summer doldrums week where just everybody's out. So I don't read too much into what happens as far as breakouts. You can take them, take a breakout on face value, just use stops and maybe consider a little bit tighter stops if that breakout fails. I'm going to go over just a very quick update on the indexes and then the things I'm watching. That's those are Treasury bonds, the U.S. dollar, and then there are quite a few trade updates I want to hit on today. There were a couple good questions in the comment section, and I give you a couple trade ideas today. So let me start out here with just the broad markets. I know this is a busy board, but as you can see, this was the previous high right here in the S&P 500 via SPY, the tracking ETF. So there's that marginal new high. Been very open to and looking for 50-50 odds since we took out the 200-day moving averages back here. So that check mark's now happened. Where we go from here, that's the big $1 million question. We still very, very much, as predicted we would at the time, have divergence, negative divergence, so a divergent high. And as I say, more often than not, breakouts that occur with negative divergence and overbought conditions will usually fail. Again, more often than not, is not always. It's just exactly what it sounds like. The probability says it's favorable that the breakouts will fail. And exactly where, we'll see. We'll look for any type of decent sell signals. Don't really see much yet. Almost an evening star doji sitting right there on QQQ. But again, let's just see what happens after this week. I'm not going to read too much into anything that happens between now and next week. So there's QQQ, again, marginal, meaning ever so slightly higher high with negative divergence. And of course, we still have the big divergence on the weekly chart and even the monthly charts, which is very unusual to get such big divergence. And that meshes with my longer term downside targets. If you're new to the site, which I still maintain, 4 to 8 are right here, calling for a drop from where we're at today. If my seventh and final targets hit, that's going to be a drop of 53%. And still very, very much everything I see in the charts say that will most likely happen. All right, so the SPY and QQQ, those are the two big cap indexes I follow. This is QQQE, the equal weighted. I have different boards here. Let me show you. Equal weighted right here, eking out an ever so slightly marginal and still very much divergent high, just like a regular QQQ. I'm watching the weekly charts this week to see if these PPO trend indicators, meaning the signal line, the 9 EMA there, closes back on or below the zero line that denotes bullish trends when it's above, and it denotes bearish trends when it's below, right? And so that's where we're at. When we drop down to the daily chart, you can see here, this is what QQQE, the equal weighted, looks like. It's such a slight marginal new high that you almost have to zoom in to see it. And there's the previous high. Let me see if I had it set right. 9 high there, 97.98. So I was 3 pennies off, just 4 pennies off. There it is. So there's we're pretty much where we were right now back in February when the equal weighted peaks. So equal weighted, and I do this because it's a measure of market breadth. You can also see, as I've talked about, let me take this line away. You can see down below my volume bars, volume's dropping off, although not as many people trade the equal weighted. It's a way to get a quick measure of market breadth when you see divergence or underperformance, and it shows you. And what we all know, they're towards the end of a market top, usually see that run in. Everybody wants to own the big names, the Nvidias of the world and Amazons and all that good stuff. RSP is your equal weighted S&P 500 tracking ETF, which hasn't even come close to its previous highs right here. I've just put a line. You can see the previous high was 188.16 right there. So close enough. I have it at 188.10. Again, not far. I just wanted to point that out. And this, actually, I'm going to just borrow that other trend line. Let me just take that away. This is what you'd be looking at on the equal weighted. You have a bearish rising wedge pattern. So, looking for any type of sell signal, you want to see if that gets broken. Let me see if we can replicate that on SPY. Let's borrow that same line. No, not as clear because you have just a more of a very indicative of from my experience of a blow off type top. I've seen this before where you get these just multiple, usually 5, 6, almost a week of straight green candles. nearly vertical on low volume, declining volume, and that's usually, and you had it right here, so exactly what you had, and there was a peak there, and we didn't go any higher. We went sideways for a while, equaled that peak, and as I highlighted back then, we were in this trading range with a sell signal to come on a break below it, so that's when we had powerful sell signals. We had some earlier ones in there with the trend line break and everything else, and so now, what to watch for? Obviously, a failed breakout, meaning a move back down below there. As I told you before, it's to be expected. It's more than common when you come back in to slightly undercut. So a simple move, a couple points or a couple pennies down below that previous high right there from, end of February doesn't mean you're going to crater. It's a start. It is at that very moment a failed breakout. So then what I look for is with every tick lower, it increases the odds that that's going to be a failed breakout, aka bull trap that sticks. But again, it's as I just said, it's an incremental thing that the deeper you go, the more and more stops start to get hit, and the more and more it helps to firm up the technicals, give you the bullish crossovers, PPO. But as I've been saying for quite a while now, for months, as far as the long-term positions, those long-term targets I just shared with you, I made it clear when we got into my bounce target zone, no more shorting above the 200-day moving averages, and they need to go to a full long-term swing/trend short. I'm talking those holding out for those much deeper targets, and we got a ways to go to get back to the 200s. But if we get there, I put good money they'll break, because usually once you've undercut and regained the 200s, that's it. You don't visit them for a long time. If we visit them again, meaning come back down after just recovering and after this breakdown, that would be much more typical of just a bear market rally, a strong one that overshot those 200s. So therefore, if we get down there, again, I would put the odds on them. Ultimately, they'll buy them again. The machines always buy the 200s, almost always. Even if they overshoot it briefly, they'll come back to them. But again, whether they buy them on the first pullback to them or not, I think they will go. But again, that's so far away. Let's not even talk much more about it right now. It seems so far, because again, momentum slowing. This is where the bulk of the money's been made in the rally. This is where many people on this site tend to forget we were long off those lows into that level, and that was our scale back in zone. And then you can see the momentum. That's where the quick money. In fact, we hit it on day 2 days after covering all those shorts going long there. Just a single day, biggest gain in years right there. And we hit it again. So what this is, and this is what the momentum indicators show you, that the market's going up. It's still going up, but not nearly at the rate of ascent it was. And that's what happens at the end of a bull run. Market's going up, and it's pretty powerful. The advances are pretty powerful. You get corrections. Then all of a sudden, it's going up a lot less. And that's where you get, as you have back here, the negative divergence. These are momentum indicators. And when prices are going up, making higher highs, and the momentum indicators are making lower highs, that's the negative divergence that often, much more often than not, but not always, precedes trend changes. So we just need to get some kind of sell signal in here, something half decent or better. Right now, we don't have anything of the sort, so we'll just sit and watch and wait and see what happens. All right, so I already covered the equal weighteds. Let's move on to the other things I'm watching really quickly. TLT. Let me drop down to a 60-minute chart. This is the 30-year Treasury bond ETF. I gave you recently this trend line here, which I set in this horizontal support level right there, 87.12, and this wedge, I said you would get a sell signal and a break of this minor uptrend line. First target would be that 87.12. We hit it, and you can see we've been dancing on it like a champ since. Right there, we hit it almost to the button. Every candle's held there, so that was the first target or support, and this is the next support level. So the way it works is support until unless broken. So we could bounce back, then that's resistance, or maybe we stay on there. This is the weaker of the two. When I say I expect a reaction upon the initial tag of each of my targets or support levels, that means it can happen in one of two ways. I often talk about a reaction. When you drop I use the hacky sack and the golf ball analogy. Drop them both on a concrete floor, the golf ball is going to bounce. That's a reaction in price, whereas the hacky sack's going to just stick there flat on the floor. That's the reaction in time, where you had the reaction. And that's the more bearish of the two. It just shows there's not a lot of other buyers on side to buy that pullback to support. Now, again, let me me repeat it again. Support is support until unless broken. So sometimes you go and correct a little bit on time, and then they'll come in and buy. Bottom line is until and unless the 87-ish level, 87.12 is taken out, that's support. And then the trend line's next, and then you can see these other levels. And again, something to watch for. Again, I've made this clear recently. I'm watching treasuries more to kind of get some clues on the market than, and I don't care to trade them right now. That's just me. I've been at a lot of trades on treasuries this year, and I'm just kind of using them to keep an eye on things. Just like the dollar, watching UUP, no change, guys. I'm showing it on a weekly chart now. I've showed it to you on the daily. This is that multi-year trading range we're at the bottom of right now. Weekly, I'm waiting to see a bullish crossover, a low-level bullish crossover on the PPO. That's when this blue line crosses the signal line, the white line there. That was the last one. I've covered this many times right there. Then we had one right here. You can just follow these lines up and see where the levels, this was where the lines kissed, and there was the bullish cross right there. So you can see what happened in the dollar when those happen. It's a great trend change indicator, just like these high-level bearish PPO crossovers like this one right here are great trend change indicators. When that happens, I've already talked about my expectations for gold, silver, and the miners because of the rallying dollar. And of course, you also have to take out the trend line. So that would be another buy signal, especially on a weekly closing basis. If you're looking at the weekly chart here, or you can view it on the daily chart and see the same thing. Bullish falling wedge. And yeah, nice setup there. So yeah, I am currently bullish the dollar, but again, just watching that more to confirm once we start getting some traction on a rally to help signal the next buy signal or object a short entry in the metals and miners. Okay, I'm going to work my way over to some individual trade ideas in just a second, including some new ones. A couple folks in the comment sections asked about some stocks. Some will look pretty nice. So I'll get to those in just 1 second. Just wanted to make sure everybody was aware today. We had the ADP employment report and missed by a mile. In fact, I'll show you on the charts what that did. So the consensus was for 50 to 125,000 jobs, between 50 to 125 gains, with a consensus of 103, negative 33,000. Of course, the bobbleheads, I'm sure, will spin it the way they want to spin it on Bubble TV, but let's look at the charts. Charts are the charts. So let me go to this one here. No, let me look at this one here. This is the easiest way to do it right here. I got to make this a little bigger for you. So if I go back here and I go to max, you have this distortion. COVID, for the first time in the history of the world, since before the dinosaurs are walking around, the modern world as we know it got shut down when COVID hit. And you know that. Your great leaders all freaked out and, made a bigger deal than I might believe they should have made over, a novel virus. But either way, whatever. So we know the world shut down. So you got this big distortion. It's almost impossible to read the chart. So the way to do this is take it and you go back like this. Let's get rid of that COVID thing. Just giving you kind of tips on how to. There's some charting programs when you have, like on Interactive Brokers, you can remove a bar. If there's an errant bar on a chart, some huge bar that shouldn't even be there or just a spike, you can take that out. I can't do it here. So now I can show you this way here. We go in and you can see as we get a little closer, let's go to a bar chart. That's the first time. Look at this. And again, what I want to show you here is a trend. So remember, after COVID, everything went wonky. World came to an end, stopped spinning, businesses had to shut down, the world economy shut down, everyone was sequestered in their house and all that good stuff. And so it took a little while for the dust to settle. And so what I was going to say is there was a huge gain after that big drop. I'll get to that in a second. And then a huge surge up. Obviously, when they turned the light switch back on, there was a lot of hiring, rehiring, and all that good stuff. So you had this one little negative bar here 1 month back in late 2020, early 2021. Other than that, what I look at are trends, guys. This is from taking right now fundamental analysis, which is the job market. It's probably not a single more important metric out there of all these crazy indicators and monthly and weekly reports and monthly reports that come out on the economic calendar. jobs, we all know, is by far the most important, because when the job market goes, consumer spending goes. Consumer spending is 70% of GDP. The government can spend as much as they want, and they will, but it can't put a dent in what a big drop in consumer spending will do. And there's never been a time in history, nor would there be, if job market turns and start that trend. I'll get to that one second. And the consumer just keeps spending. They're already maxed out. I do follow things such as credit card debt balances and new debt originations. I follow a lot of that good stuff. So consumers tapped out. In fact, that's what's kept this economy going, is the access to credit. And so you can see, again, just look at these bars, do it any way you want. You can put it on a line chart. I like this bar chart. And it doesn't take an expert market technician to see the trend. Even if you take out the spikes, the highs and the low, this is higher, lower highs. You can see here where it's going, and now it's crossed. So you were getting fewer and fewer jobs created, now negative jobs. And so when we go back again, if I come back in, you can see there's COVID, so that huge up spikes. It kind of you have to get away from that period. And I like to look at history. So you go back as far as we can go here, and again, you just drag this little slider here. Hopefully you guys can see that in a video. I'll make it bigger. My bad. I should have done that before. And then we take those away. There we go. And I stretch this up a little bit. We got to go in a little bit more. There. Now you can see the bars. So that's why I did that. So I wish, I can't do it here, but if I could overlay the S&P 500 on this particular chart, this platform doesn't give me the option. But or I know, the last two what I call real recessions, yes, COVID technically, but the big ones and last true real bear markets were the 2000 bubble that popped in March 2000. So you had a bear market from early 2000 into the mid 2002 lows, and a recession as well. And that's the tail. And this is as far back. I can't go any farther. So that shows all the job losses there. And again, if I could, what I was trying to say earlier, some of these charts will let you overlay the shading of recessions. And this was the next bull market. You guys remember the big bull market up to 2007 highs. Technically was October of 2007, right about here. Right, exactly right about there it is. Right there, we've had that little negative bump in January, shot across the bow. Then by the end of the year, you can see, and again, you don't have to be an expert chart reader. What's the trend? A lot of job creation, strong economy, i.e. strong stock market. Jobs started turning, job market started softening, right? We were still positive growth, but less and less. And right about here is where the stock market peaked in the end of 2007. And you can see that inflection. Again, you can just follow the trend. And then, there's some positive months, but just smooth out and look at the trend. So there was the Great Recession. That's what happened. And then everything returned to normal until now, what I just covered again. I just went back, go like this, and showed you the trend that has been in place since, really, if you have to take out that COVID thing. And now, boom. So where were we? Had it there when I was in there before. You had that first negative blip. Something's not letting me zoom all the way back there and go 2 years. You can see it 1 year, wherever it was. Something happened here. Refresh. Well, I showed it to you before. There it is. Boom. Came back now. All right, so that's that. Let's look at this chart. I don't know why they're not showing it now. This is Macro Trends, one of my favorite sites. They usually shade the recessions in here, and it's not showing right now. I've showed this chart to you a gazillion and one times, and invariably with zero exceptions. You can look back, and you can see that employment falls down to these record low levels. And this is what stock market cheerleaders do. They come out and tell you, well, here's why we're going to have another positive year in 2025 and well into 2026 before a recession, because employment's at record lows. Okay. But as I pointed out many, many times, when it falls down to this, this range here, record low levels, especially modern history, since in the 2000s, comes down about this level, without exception, always. Again, zero exceptions. It's a V bottom. You never stay down. This one, you stayed there for a little bit. That was a wonky period in the 70s. But again, you kept going lower. And then once the turn was in, once the turn is in, and again, you would see recession shaded areas here on all these big moves up. These were all recessions and bear markets. There's zero variability or exception to this, and again, it's taken a while, but and the turn is in. You can see here. Here, I'll drop it down. The turn has been in already. The inflection point, if you will. And again, I talked about getting a little more granular and look at the micro trends. You have a series of lower highs. You always have these little blips, and you can't say any of these are the bottom because that's just a normal blip within a normal trend. But clearly, it's turned. And again, it's as the market is as normal. The market will dismiss things when you get into a bull market. It's just investor psychology at the end, the FOMO, the fear of missing out. It's a momentum trade. I'm always careful. The words this time will be different. That's a famous saying in the markets. Maybe it will be. Maybe we'll see this inflection, and then all of a sudden we come back down and we stay here at record low employment for a long time. But again, as the chart shows, you can go back as long as you want. These are V bottoms. The V is already in, and I just showed you now, additional support that the job market's rolling over, and there's no exception that I've ever seen. You go back in history that you've seen the job market roll over, clearly inflect and turn. Again, anything is possible. To see unemployment just remain here or go back down, it would just be atypical. It would be the first time haven't seen a V bottom when we get down to these record low levels. So that's that. And again, you got to get the timing right because and that's why we're waiting for the next sell signals on the charts, on the daily and weekly charts of the indexes, market leading stocks. There's certainly that FOMO trade, the AI bubble going on right now, and that happened back in 2000. It went on and went on. And remember, there's a positive feedback loop between the stock market gains. This was the dot-com bubble, and we hit back then. Markets started becoming really overvalued here, and it just kept going up and getting overvalued until the bubble popped, as I told you in the beginning of March of 2000. That's when it popped, and then it didn't. And you can see it turned. Nobody believed they were buying the dip. They were buying the corrections for a while. Thought the market would keep going. You back up to new highs, and finally, once it became clear, the acceleration began in the once it turns in. You usually get that turns, and then you get that strong acceleration. Turns, and then you get the strong acceleration, right? And so that's why I'll be watching the job data, job numbers very closely going forward. And market shrugged this one. It was a negative reaction initially, and then they bought it up. Why did they buy it up? Because the Fed's going to cut. I encourage you to do this. Look at the history of rate cuts. The first rate cut after a rate hiking cycle, money think they're trying to spin it right now on TV as bullish. That is a sell signal in the market. That's when bear markets and corrections come after a Fed rate hiking cycle, because the only reason they cut is they finally see the turn in the economy, and the Fed's always behind the curve. So you can look back. I remember in 2000, I was talking about that. That was a 78, again, nearly 80% drop in the NASDAQ composite from highs to low back when that dot-com bubble popped. Wiped a lot of people out. And there's, I remember reading, and I have it saved somewhere, an article in the Wall Street Journal back then. There was a 50 basis point intermeeting rate cut by the Fed. The market had its biggest one-day gain in I forget how many decades. It exploded higher. This is after the peak was already in. And from there, it fell after that. Even if you bought before that record pop, you were still 6 or 12 months later down, like, I don't know what it was, 50+% on your money. In other words, that was just the first. They realized they were behind the curve, as they always do. And so that was, you would have been much better off selling at that point than buying. So, all right, so we'll watch the calendar. You guys can access this on the site. That was today right there. That was today. The ADP employment report. Tomorrow you've got jobless claims right here, employment situation, and you can see the calendar, ISM, factory order, some other stuff there. Okay, so I threw out MOH. Again, take it, don't take it. It's going to be highly correlated with the It's one of the healthcare plan companies. Somebody asked me this one, Blueberry. Can you look at Estee Lauder long-term investment? Not copying his moves, just being mindful. My reply, I meant to put the little LOL thing or whatever you guys do now, the younger generation. This was EL was a beautiful looking chart, although I wished you had asked me about it back in April when it put in that big divergent low on the daily and weekly charts. But anyways, that's where the little smiley face or whatever should be. However, no, going forward, because this is important. So it's still a good looking chart. More upside in the coming months, likely, assuming the stock market doesn't shit the bed, which is also likely. So if that seems like a backhanded, statement, well, again, so if you break this apart, so if the stock market doesn't shit the bed, it means keeps going up, then yes, I think this is one of the better looking stocks. However, I also think, in the coming months, by the end of the year, market will be down a lot more, but we'll see. And so what do you do with that? Take it. It's a good looking chart. Well, I'll show you where. And then especially if for those of you that are going to, whether now or you plan to short the market later, you can have these offsetting positions. I love doing that, especially when there's a strong tape. There's, no sell signals in the market. But right now, it's a game of musical chairs, the music playing, and I like these bottom plays more than the ones breaking out to new highs right now. I just feel it's just my kind of chart. So, anywho, let me show you the levels here. So what I said, this is the daily, daily chart here. This is the daily. Let me change my arrow color back to this. All right, so you can see here, this is a big old fat gap right here. So on the daily chart, that's gap resistance. You can see they already shot it down there at the gap. And so we're right there. It's pretty extended run. Just took out the 200s. That's nice. You can see the 200s do a great job on many stocks in a bear market of capping all advances. So when you rally to the 200s and get rejected, you're in a bear market. You keep selling those 200s. And then you start waiting. It's not random when I see positive divergence. Remember, I was covering all shorts going long in the end of right there off the April lows. Not this particular stock, wish I was, but that was it. And it was a beautiful looking chart. So that was the technical catalyst. Then it took out this trend line. It just recently took out the 200s, but it's very overbought. This is the RSI right there, 80 something right there. Hasn't been this overbought in years at nice gap resistance as I just showed you. So my preference would be to wait for a pullback. There's a nice uptrend line. That would certainly be an objective entry. The 200s are just below it as well. And then I gave you price targets. I also gave the weekly chart right here. You can see on the weekly chart, big positive divergence, big divergent low. There's your positive divergence. And it took out this trend line just now, took out the 200s. So these are, if you want to use the weekly charts for targets, and if we're in some super duper bull market that's got a lot of room to run this year and there is no top and I'm wrong on those long-term calls, this stock, I will most likely add an additional target right here up to about 158. So nice looking chart. Thanks for pointing that out. And again, it's not too late. It's off the bottom a lot, but again, when you look at it, something like that, let me go back to EL. Remember, there's a stock. Again, this one has a lot of goodwill. The name. Everyone knows Estee Lauder. You don't even have to be a woman you've heard of Estee Lauder, cosmetic company or whatever. The stock's down 86%. So you're buying a brand name company, a leader in the industry. Is it up off the bottom already 80%? Yeah, but it could go up another. From here, or from the bottom, it can go up 200%, and it's still half of what it was before. So you got to look at it that way. But again, it's very overbought right now. I wouldn't buy it with your money. That's just me. But I would buy it on a pullback, and I probably will. So there's your setup for EL. And like I said, I did go on to say that too, that if it, I gave you two objective entries. You could take a position. I would prefer to go long on a pullback correction, but if it powers through the gap, you can wait. Once that gap resistance is taken out, you can certainly add to it. It's not my favorite type of play. I don't like to chase things that are very overbought. So I'll wait for a pullback, but I just showed you the big gap, and if it can clearly power through that gap, maybe it keeps running. That's certainly a possibility. Somebody asked CNC, which is Centene, down 40%. My reply, before I put out the MOH trade and the update on the OSCR, Oscar Health, I did look at CNC. I went to see why Oscar Health was down so much. That's how I found the other two. And yeah, it's this guy led the party today. Big drop, down 40% or whatever. So here's my reply. I looked at CNC earlier today, since they're the one that started this bloodbath in the sector. Despite the massive drop and extreme oversold conditions, I didn't then and still don't like the chart, since it's what the stock is in what I call no man's land. That is when you're smack between long support and resistance. So here's the chart. Now, who knows? Maybe this is a weekly chart. See, my chart time frames are up in the top hand left hand corner. W right there. Oops. W for weekly chart. So maybe between now and Friday's close, it goes back here, and then it will have successfully closed on and held or defended that long-term support. Nice long-term support level there. As of now, it's smack in no man's land. I don't buy stocks in no man's land. It's just like playing tennis. You're going to play the net, you can play back on the court, but you don't play in the middle. They're just going to lob it over your head, or they're going to put a lob shot that drops right down in front of the net, and you're not going to get to either of those. That's the same thing here, because this one can go up here and bounce back to 40, and then maybe it gets rejected, goes down, or it continues on down to that next long-term support way down there. Again, either way, it could pop up and it could do this. It doesn't mean I'm wrong because I'm not shorting it or taking a position. It just means it's not my type of stock. So that's why. And unlike the others that I gave you, this one does not have positive divergence. You can see that's not. So there's nothing in here to like. And yeah, that's a hell of a drop. Yes, you're going to have some powerful short covering rally sooner than later in this one. It's not penny stockville, and it could happen tomorrow or next week. But I just can't make an objective entry. I hope you guys understand that, because I've had over the time, not many, but sometimes people bring up, why weren't we long XYZ? And I'm like, first of all, I don't follow all 10,000 stocks out there in the universe of or more in stocks. And also, there's a million of stocks popping every day. If I can't look at a chart and I can't make a clear bullish or bearish case to be long or short that stock with an objective entry point, so then I can quantify and strategically place my stops and my price targets, I pass on it. So that's it. So CNC, yeah, well, if the sector pops next week, and in fact, I mentioned birds of a feather flock together. So if CNC continues to fall down to that next support, guess what? MOH and OSCR, they're probably going to fall as well, most likely. I don't know. Yeah, and that's about it, guys. There's not much more that I'm seeing or excited about this week. The VIX is still very, very much set up constructively, ready for, seems like the next pop it, but it needs a catalyst. The VIX will not go up until the market starts going down, but you still have, I've highlighted every divergent low we've had in the last couple of years. We were long of those, and we nailed the price target. So far, we nailed T2 there, got out, shorted it, reversed it, and I still think we'll get a move up to T3. I don't know what it's going to be. There could be 101 catalysts. If we want to take guesses, Trump's big bloated bill starts running into trouble in the House. There's, World War, not World War III, but yeah, obviously they're not singing Kumbaya in the Middle East, although the media wants to portray it that way. So there's all that going on over there. And then, of course, the economic calendar. I think Trump's trade wars and his craziness and Israel and Iran have kind of diverted attention away from things like the job number. And either way, all I can tell you guys is technically, as long as you have that positive divergence, remember, it took a while here, it's highlight, and then we went long right there, right in time. That was when it was added officially. And we went long right there, right before that breakout too. And so this one, I can't make an objective long entry right now because divergence is not a buy signal. Need to see some type of reversal in the stock market, and then this will most likely take off. That's how it looks on the 60-minute chart. I've been highlighting. It's been making divergent low. The divergence is not only not taken out, it's just getting bigger. So, and divergences, again, aren't buy signals. It's possible we go on down and ultimately that divergence is taken out, but right now it's still very much in place. And if you look at the stock market making new highs, but yet And forget about VIXY. I mean, that's our trading proxy because you can't buy the VIX directly, only futures or options on the VIX. But the VIX itself, just like VIXY, what's going on here? It's making these higher lows. In the stock market's at new all-time highs. You can see nice big positive divergence on the VIX. It continues to extend. And so that's it. We just need that catalyst to pop it up and give us the next run up. And if you're new to the site, as I've mentioned many times, this is usually where bear markets end, right here, that big level right there. COVID, 2007 to 9 bear market, and this drop we saw recently. This is where corrections usually end. So either way, the VIX is still coming off that big divergent low right there, still moving higher. And then the other things I meant to hit in the beginning of the video with the dollar and everything else I'm watching. I covered TLT, but also IEF, the 10-year Treasury bond ETF, right on trendline support now. And I'm just a little bit above my red zone after briefly kissing my orange zone. Again, as I've showed you, every time we've punched into the orange zone, corrections followed shortly thereafter. So we hit it. It wasn't very long. We kissed it there and then entered it there. And the market corrected, we entered it there, but briefly. So if we break this line, look for another move back down into the orange zone, especially a solid move in there. That would be net bearish for the stock market. And then the other one I gave you the other day was crude oil. As far as the zones there, remember we punched all the way to the top of my orange zone recently. I've covered this chart with you before. Without fail, again, just like the job market, it could be a first. It will be a first if we aren't soon followed. Remember, we only just hit it. We just got in there, and we're only about a week or so off that. So historically, as I've showed you, I don't have the chart queued up right now in front of me, but I did show you that in recent weeks. Every other time we got in there, the stock market correction followed, either a little one and we're double, high single digits, or well into the double digits. And so this would be a first if it doesn't happen. Plus, when I go down shorter term, just recently I told you my expectation will pop back up that crude had what I recognize as a textbook looking, little bear flag, bearish pennant, but I told you I didn't think it was going to play out. If it did, we would have took crude down here. And that's it. We'd probably consolidate and then break to the upside. So right now we're starting to break. I added a couple levels to this chart right here. It seems this is the box. You can see these two levels, 64.41 on crude futures and about 66.48. We're just starting to pop that. And I think that will bring crude up. And then that will most likely put, again, it's a incremental thing. We pop that, it's not going to crash the market. We got to get back up into those zones I talked about. And then that will continue to put pressure on the market. This was a very brief stint up there, followed by a quick swoon down. But again, keep an eye. It's something I'm watching right now. All right, let me wrap it up here with all that being said. Holiday week, abbreviated trading week. So let's we'll watch. We'll see what happens this week. I'll be around, as I told you. I'm in quasi-vacation mode. I'm going to wrap this video up and run out and do an errand right now with my son. But all right, I'm going to get the video out to you guys. And if you have any questions, as usual, want my opinion on a chart, just post it under the comment section here. This has been Randy Finney with Right Side of the Chart. Have a great day.